All right, let's get started, shall we? My name is Jamie Keech. I am the host of a mining podcast called the Resource Insider Podcast, where we interview leaders in the space and we try to get an idea of how they're making decisions, how they got where they are, and how they're building the companies that they're involved in. And when I got invited today to lead a panel, I knew immediately I wanted to talk about royalties and streaming. This has been a growing part of the mining industry for years, particularly the last decade, and I believe it's going to play a bigger and bigger role as we go forward. And today we've got a panel of leaders from three of the best companies in the space, in my view. All these companies are different sizes, they're at different stages of their development, and they're going to continue to grow and create shareholder value over the coming decade and beyond. So let's start off with introducing ourselves. If you could each say your name, who you work with, and what you do, and let's start with you, Gary, down at the end.
My name is Gary Brown. I'm the CFO of Wheaton Precious Metals.
Good morning, my name is Dan O'Flaherty. I'm the CEO of Maverix Metals. Maverix is one of the newest entrants to the precious metal royalty sector, having spun out in July of 2016 from Pan American Silver.
And my name is Nolan Watson. I'm president and CEO of a company called Sandstorm Gold Royalties.
All right, so getting started, let's start easy. And Gary, could you give us a very brief overview of what is a royalty and a stream, and what are the difference between those two things?
Sure. So generally, a royalty will be a contract that really represents a covenant that runs with the land that the royalty covers. So in North America, generally in an insolvency type situation, that contract will survive the insolvency, whereas with streaming arrangements, they represent contracts that could be frustrated through an insolvency process. That being said, what we'll generally do is seek to have security in the underlying assets to protect ourselves from that type of situation, and we generally only look to do streams relative to low cost assets. Also, the streaming arrangements can be structured in a way that's much more tax efficient for the mining company. And so we've seen very few royalties done over the last decade. Most of the financings have been streaming contracts in the space.
Now, there are a lot of people out there trying to buy royalties, trying to buy streams. Some are trying to create them. When you guys go out and you look to evaluate a project and potentially buy a stream, what are the qualities you look for? Dan, maybe you could give us an overview of what Maverix is actually looking for and why they would buy something. What are the aspects of that?
Yes, of course, Jamie, thank you. And this is a question that's very specific to each royalty and streaming company, and I can answer for Maverix. What we're looking for, first and foremost, is precious metals. We are very much focused on gold and silver. We're also looking for assets that have a cash flow profile, either cash flowing or within the next 1 to 2 years with a clear path to production. That is our focus. We also look at assets that have a very low cost structure, such that the royalty or stream doesn't impact the profitability of the underlying mine. Jurisdiction is also very important to Maverix. We have 90% of our revenues from Canada, the United States, Australia, and Mexico, so that's certainly something that we look for. And finally, the underlying operator. We look to partner with strong mining companies as our partners for the royalty and streaming transactions that we do. And just, of course, good assets at the end of the day is very important as well.
So, I mean, most of your companies, you all have a combination of actually cash flowing royalties that are producing money right now, and royalties on exploration and development projects that are yet to be actually cash flowing. Nolan, could you talk a little bit about how a company wants to, I guess, balance its portfolio so it has enough cash flowing assets, but also the upside in the future on these exploration style properties and development stage properties?
Yeah, it's kind of one of the interesting things when you're building a streaming and a royalty company is what type of assets do you buy? Do you buy things that are cash flowing now? Do you buy things that are going to be cash flowing 4 years from now? And because the value that you have to pay up front differs dramatically. If it's something that's cash flowing today, you have to pay a lot. If it's something that's cash flowing 4 years from now, you can usually get it for a small fraction of its inherent value, because 4 years from now is an eternity for most people to wait for. And so what we've done at Sandstorm is we have focused and tried to build a portfolio that is all through various stages of production. So we have a significant number of our assets that are in production today. We're going to have probably $100 million Canadian of free cash flow next year just from our producing royalty portfolio. And then we've got a number of assets that are in development, and so we've got a huge amount of growth. Our production we expect to double over the next 3 years, just solely based on things we've already bought as they develop. And then we've got about another 100 plus exploration royalties that are at various stages of advanced exploration and development. And so we try to build that whole portfolio so you have production, development, and exploration all inside one portfolio. And of course, you pay different amounts for that. So when we look at the capital we've allocated over the last 10 years, probably 80 to 85% of that capital has been allocated to that first bucket of producing or soon to be producing royalties and streams.
So, I mean, looking at this from the perspective of an investor or a shareholder of a company, when I'm looking at investing in a mining company and there's a royalty on that company or a stream on that company, I try to get an idea of what impact that will have on the profitability of the asset, on the success of that company. And when you guys are looking at purchasing or creating a stream or a royalty, how do you go about finding that balance where you're getting a profitable royalty for you and rewarding your shareholders, but still allowing the company to make the money that it needs and to be successful in its own right, a successful partner? And Gary, maybe you could talk about how Wheaton Precious has done that in the past and going forward.
Sure. So first off, I think this is common to all of us. We don't take any operating control from the mining company. So they still have full latitude to operate their mines as they see fit. So it's very important that these mines can be economical in virtually any type of commodity price environment. So first and foremost, we focused on low-cost operations that have high margins. And currently, about 96% of our production comes from mines that operate in the lowest half of their respective cost quartiles, and the vast majority of that is first quartile producers. And then we look at the economics that we're taking from that mining operation, and the vast majority of our streams, we're taking a byproduct that the mine doesn't really care about. So we're taking gold or silver, gold from a copper mine or silver from a lead zinc mine. So they're not really interested in that metal to begin with. And we have a hard stop at 20%. Like, we wouldn't do a stream where we were taking more than 20% of the after-tax economics from the mine. And if you look across our portfolio, and we have interests in 29 different mining assets, 20 of which are currently operating. And of those operating assets, we're taking about 7 or 8% on average of the after-tax economics.
So Dan, Maverix has been on a tear the last couple of years. You guys have acquired a lot of royalties. Some of them have been on the primary commodity, others on the secondary commodity. Do you look at that any differently when you're evaluating this, or is it more just how much off the top will be taken out of the company? How do you evaluate the difference between those?
Thanks, Jamie. I think Gary articulated that very well, as it is common for the royalty and streamers. First and foremost is the underlying profitability of the mine. That is the most important part, is making sure that it is a win-win transaction for both the operator as well as the streamer. So not taking too much of the economics, as Gary mentioned. Also, for the underlying operator, they have their own shareholders who own them for their primary product, which in the case of a copper mine with a gold byproduct, the gold is less important to them, and it becomes more of a win-win when we take the secondary metal as opposed to the primary product.
Okay, so as we've seen the industry change over the last few years, a lot of the traditional source of capital has dried up. These funds or sovereign wealth funds or banks that have traditionally provided a lot of the money that mining companies have relied on. And royalty companies, and all three of your companies have stepped up and largely filled that gap. And I want to ask you this, Nolan, how do you see the role of these companies evolving as we go forward? And Sandstorm has done a great job of taking equity positions in a lot of the earlier stage companies that you're buying royalties on. And what do you think the importance is of that, and how do you see that going forward?
Yeah, one of the things that we're seeing in the capital markets right now is this massive shift of actively managed capital. So retail investors such as yourselves managing your own money, or institutional investors with a large pile of capital managing that money, shifting it over to passively managed, so ETFs, where you basically have computer algorithms making those investments solely based on criteria of things like industry, size, and liquidity of the company. So if you're X size and you trade a certain amount of volume and you're a gold company, then you're in the ETF. And if you don't meet those criteria, you're not. And the problem is that we've got an entire floor here of companies at that conference that don't meet any of those criteria. Virtually nobody here meets that criteria, and therefore a huge percentage of the capital that was in the world that could be invested in these companies can't be anymore. And so royalty and streaming companies have tried to step in and fill some of that void, but even we aren't enough. And so what we're trying to do at Sandstorm, and I think some of the other companies are trying to figure this out as well, is answer the question, how do we help the companies more than just by providing them capital, by convincing other investors and aggregating them together to say, look, we've looked at this seriously, we've done the due diligence, we know the management team, we believe in the asset, Sandstorm is going to buy a stream or a royalty on this asset, and we're also going to become an equity shareholder at the same time because we believe fundamentally that the equity is undervalued. And oh, by the way, if we know of investors, we'll bring them in. And so we've done this for a number of companies now where we actually acted as an unpaid investment banker. We built the entire equity book for them, and we handed them a list of 30 names and said, phone these guys, they will invest, and that'll be your equity financing. And so we've actually more formalized that inside Sandstorm. We started something called the Launch Lab, which is basically just a list of investors who want to call the next time we think we found something cool. We're not investment advisors. We're not allowed to recommend that you invest in it. We never will, but we'll say, here's something you should look at. Go phone the company and talk to your investment advisor and decide for yourself. And so that way we can actually get smart retail investors and smart institutional investors besides Sandstorm, which we think we're smart money with good due diligence capacity. And we can actually make a company successful together as long as their asset is of high enough quality to realize that potential.
Okay. This is a pretty competitive space. Who here owns stock in one royalty or streaming company or another? A lot of people. You've probably noticed the trend that there's more and more and more royalty companies and streaming companies coming on every year. And you're competing for what must feel like a smaller and smaller pot. Sandstorm's been around for 10 years. Silver Wheaton, I think 15 years. Wheaton Precious for 15 years. Maverix has been around for 2 years. And you guys have been, I would say, arguably the most successful new royalty company in that time. You've gone from a market cap of $0 to $500 million in 2 years. How were you able to reach that critical size? And if these people out here, they're looking to invest in a newer royalty company, what key aspects should they be looking for so that it doesn't stagnate as a 1 or 2 royalty company, it never really goes anywhere, and it can't do much after that?
Thanks, Jamie. I think as Nolan mentioned, the market for royalty and streaming companies is continuing to grow dramatically. There is an incredible amount of opportunities for all Wheaton, Precious, and Sandstorm, and for Maverix to all be able to provide financing and capital for the underlying operators, just particularly given the market that we're currently in with respect to financing for the junior and developing gold and precious metals companies. With respect to Maverix, we spun out of Pan American Silver with an initial portfolio, and that gave us the critical mass to really build a platform and continuing to acquire more royalties. We over the past 2 years, since listing in 2016, we acquired 80 royalties, 12 of which are cash flowing in 8 separate transactions. So it's a busy space right now, and we continue to see opportunities. And the royalty and streaming sector in general is growing enough where there is room for all of us to continue to be able to complete growth transactions.
Do you think the smaller companies that have a basket of of assets that aren't cash flowing yet can get capital cheap enough to compete against the bigger companies in that space? Or if they're not able to start with that strong portfolio like you guys did, are they really able to enter the space effectively?
Well, there's always a competition for capital, even amongst the royalty and streamers. But that initial critical mass, is very important because it changes the cost of capital. So it is difficult to really start from scratch. But it is, it's certainly possible, and the opportunities are there in the royalty and streaming sector.
Okay, so I want to talk about something called superstar assets. Most mining companies, the big majors, at one point started around one great mine that really churned out money. Most of the great royalty companies, Silver Wheaton among them, have 1 or 2 or 3 big assets that make a lot of money, and they've really allowed them to grow. And I want to talk to you, Nolan, because I know you've thought a lot about this, about how a royalty company that doesn't necessarily start with that star asset goes about acquiring or creating it, and how they can do that and effectively compete against the guys that already do.
I think to get those key cornerstone assets, it takes time, and you have to do it methodically over the course of a company's life. They don't come around very often, and so you have to be strategic when they do. We've bought a number of royalties over the years of streams that are large. In fact, Cerro Moro, which is our largest stream to date, just came online a couple of weeks ago, and we're pretty excited about it. It's a large silver stream mine operated by Yamana, and we'll get a lot of silver from that asset and a lot of cash flow from it. So that'll be one of our cornerstone assets. But there are situations like there is an asset in Turkey. I think it's the coolest undeveloped gold mine in the world. It's going to be able to produce gold at an all-in sustaining cost of $375 an ounce, and that's on a co-product basis. On a byproduct basis, it'll be under $100 an ounce to produce gold all in. And so there is this 30% net profit interest type contract that we went out and we bought the company that owned that, which is a bit of an atypical move for a streaming and royalty company, but that contract to us felt like a traditional NPI type royalty. We're in negotiations now with the partner to turn it into a more traditional stream. And sometimes when you find those amazing assets, you just have to be strategic about how you go about getting them and then turning them into streams. So anchor assets are an important part of building the business, but at the same time, don't forget about all the other assets. Anchor assets are great, but diversification is also an important part of our business and why we exist.
Okay. Who here has been watching the news lately, and you've seen this consolidation occurring in the gold and precious metal space? I'm sure you're all familiar with the Newmont acquisition of Gold Corp. Gary, do you think the time comes when there is an acquisition, or rather a consolidation within the royalty and streaming space, when the Wheaton Preciouses of the world start acquiring the smaller royalty companies?
It's always a tough thing for us to consider buying one of our competitors while there's still good streams to be done. We typically will go out and do streams at close to 1 times NAV, and these guys are trading at 1.3, 1.4, in some cases like 2 times NAV. So I think the time would be would require there to be no real other assets out there to make make that work. I mean, we've done that before. We did that back in 2009. We acquired our only competitor at that time, which was Silverstone, and that turned out to be one of the best returns that we've ever seen on an IRR basis. I mean, it could create opportunities down the road. I don't think the time is right for that to occur currently.
Okay, so guys, we're getting ushered off the stage now, but before we go, you're all very different sized companies. Nolan, Sandstorm, as you know, obviously is about $1 billion. Maverix is $500 million. And Wheaton Pressure's at $11 billion now. You all offer different upsides and risks to potential investors. What is your 15-second pitch for each of you about why an investor would choose Sandstorm over another company, or for each of your applicable companies? Dan, you want to start it off?
Sure. Well, first I'll say that both Nolan and Gary represent tremendous companies, and Sandstorm and Wheaton Precious Metals and Maverix are all great investment options, because fundamentally the royalty and streaming sector provides investors with very attractive leverage to precious metals prices with enhanced asset diversification, which comes with downside protection. For Maverix specifically, as the newest and fastest growing entry to the royalty sector peer group, we represent tremendous value at our size. We have a number of catalysts ahead of us, and we're in the early days of creating a very great company, and it's an exciting time for Maverix shareholders.
Thanks, Dan. Gary?
Well, we're the guys that started the metal streaming business back in 2004. We feel like we've got the highest quality portfolio out there, and we measure quality on really two fronts: where that mine falls on its respective cost curve, and as I've already outlined, we've got 96% of our production that comes from mines that operate in the lowest half of their respective cost curves. And then the second measure of quality is how long a life you've got with the mines in the portfolio. And right now, just through exhaustion of proven and probable reserves, we've got 33 years of mine life on average. And then if you look at resources being layered into that, which our asset base has shown a real propensity to deliver on, that adds about another 30 years. So we've got the lowest cost mines, and we've got very, very long lives underlying our portfolio. And we're generating about $600 million of operating cash flow currently, and I would encourage you to look at the way that we're trading right now relative to some of our peers, and I think it's pretty clear that there's a real value proposition with respect to Wheaton currently.
Great. Nolan, want to finish it off for us?
Yeah, I think when you're looking at an investment opportunity in the streaming royalty space, what you're looking for is production growth, you're looking for exploration upside, you're looking for diversification, you're looking for value. In terms of production growth, Sandstorm's got the most out of any streaming royalty company on a percentage basis. We're going to double our production in the next 3 years, solely based on things we've already bought. In terms of exploration upside, for every dollar you invest in Sandstorm, you get more meters drilled for exploration than any other streaming royalty company in the world. We've got 188 streams and royalties, which ranks us in the top 3 in the world in terms of total number of royalties in the portfolio. And then in terms of value, we're the only major streaming royalty company in the world that's currently trading under NAV, which is why we've launched a share buyback program, and we've committed to buy back 10% of our whole company by the end of 2019. We bought about 2.5% so far. We have another 7.5% to go. And so we're going to allocate $100 million Canadian buying back our own shares, so we're putting our money where our mouth is.
All right, thanks a lot, guys, and thanks for everyone to come and listen to this. If you like the conversations, we have a detailed podcast with Nolan and Dan on our website, Resource Insider. You can hear more about what they're doing, and we've got one with Gary coming soon. So thanks again.